Are rising interest rates quietly reducing the value of your ASX dividend portfolio? Many Australian investors focus on dividend yield, but when the Reserve Bank raises rates, the impact can be much bigger than most people realise. Today, we'll stress test a typical ASX income portfolio and see exactly how higher interest rates can affect your dividend income, share prices, and future returns. When interest rates rise, investors suddenly have more choices. If a savings account pays 5%, some investors may decide they don't need to take as much risk in dividend-paying shares. This creates competition for your investment dollars. Companies that were attractive because they offered a 4% dividend yield may look less appealing when cash investments offer similar returns. As a result, some dividend stocks experience downward pressure on their share prices. Let's run a simple stress test. Imagine you've invested $100,000 across major ASX dividend stocks. Your portfolio generates a healthy 5% dividend yield, giving you $5,000 per year in income. Now let's introduce a series of interest rate hikes. Higher borrowing costs can affect company profits. Banks may benefit initially from improved lending margins. However, property trusts and highly leveraged companies often face higher financing costs. Some businesses may grow more slowly, and dividend increases can become harder to sustain. Here's where many investors become concerned. Even if dividends remain stable, share prices may adjust. Our example portfolio could fall from $100,000 to $92,000 during a period of higher rates. That's an 8% decline in market value. However, your annual dividend income might still remain close to $5,000. This is why income investors often focus on cash flow rather than short-term price movements. But it's important to understand both sides of the equation. Here's the interesting part. When share prices fall but dividends remain unchanged, dividend yields actually increase. For long-term investors, periods of market weakness can create opportunities to buy quality dividend stocks at more attractive yields. This is why many experienced investors see market declines as potential buying opportunities rather than reasons to panic. So, what's the verdict from our ASX portfolio stress test? Interest rate hikes can pressure share prices, increase company borrowing costs, and create competition from cash investments. But strong dividend-paying businesses can still provide valuable income over the long term. The key is focusing on quality companies, sustainable dividends, and maintaining a long-term perspective. If you found this helpful, subscribe for more Australian investing insights and portfolio analysis. Thanks for watching.